Hello, ladies and gentlemen. Greg Michalowski from ForexLive.com. This report is for the week started February 9, 2015. I'm going to take a technical look at the Forex week ahead by focusing on the major currency pairs, including the Euro versus US dollar, which is the currency pair I'm going to start off with. And on Friday, we had a big sharp move to the downside. It was a very volatile week, as you can see, up and down with squeezes to the upside and then sell-offs to the downside. Friday was led by the stronger U.S. employment statistics. We saw non-farm payroll rise greater than expectations and saw previous revisions to prior months also rise fairly strongly. We saw the average hourly earnings rise by 0.5%, which is also some good news for the dollar and keeps the Fed on alert for a June hike. This is keeping the dollar strong and keeping the euro weak. The market is opening up below the 50% retracement of the move up from the 26th low to the high that we saw on February 3rd. That 50% retracement comes in at the 113.15 level, and that's going to be a close resistance in trading here today. Stay below that level, and the bears remain in control. Move above, and it doesn't necessarily put the bulls in control, but we could see some muddy waters and could see a resistance or a corrective move up toward the 113.66 to 72 level. That level is going to be my line in the sand, not only for the day but for the week. Stay below that level and the bears remain in control, and we look for rotations to the downside. Move above it and the waters get a little bit more muddy, and traders start to question the bearishness of the euro versus US dollar for whatever reason. We don't know, but that would be a move above that level would certainly muddy the waters. On the downside, we have our prior lows that we're going to be targeting, including the 112.78 level, the 61.8% retracement in these lows right here around the 112.63 level. Watch the 112.09 level. Okay, the 112.09 level corresponds with the 61.8% retracement of the move up from the 2000-year low to the 2008 high. That 112.09 level comes right there. So that's going to be another level on the downside. We move below, that's more bearish, and keep the momentum going to the downside. Our low for the year and most recent low going back to 2003 comes in at 110.97, and that level could be in play in trading here this week. If we were to let's say peak out up here at the 200-hour moving average down to that level, it would be about a 270 pip trading range. Not out of the question. It would be a stretch, but certainly not out of the question. So that is a possibility for the euro versus US dollar. If we don't get up to that 200-hour moving average, it makes it easier. It's only about a 218 or so pip from the 50% retracement level. So keep that in mind as a target level for this week's trade. Let's take a look at the dollar versus yen. We finally broke outside of this box right here on Friday's trade. That box had a peak at the 118.85 level, and we moved above that level. On Friday in late afternoon trading, we did move a little bit below that level, but as you can see, we're opening up higher at the 119.05 level. So that's keeping more of a bullish bias. Stay above that high level at the 118.85 level, and the bulls definitely remain in control. For the week, I would say that as long as we stay above these highs right here, with the 118.47 level kind of being the low, and as long as we stay above that level, we'll keep the bulls in charge. If we move below that 118.47 level, something else is up here for the dollar versus yen, and I consider the market might take a little note of that and rotate further to the downside on a break of that level. So keep that level in mind on the downside for support. Let's take a look at the sterling versus US dollar. This currency pair had much stronger fundamentals and bias in last week's trading, trending more to the upside until Friday's report sent the price to the downside. We did hold the 38.2% retracement of the week's trading range down here, and we are opening up and staying above that 38.2% retracement. I consider this yellow area in between the 100-hour moving average and the 38.2% retracement as our early support level for this week's trading. Stay above it, and the bulls remain in control. Move below it, and the waters get a little bit more neutral for the sterling versus US dollar. It would be a move below the 151.69 level. That's a 50% of this move to the upside, which really neutralizes the market even more. So watch that level as well on the downside. So this area right here is going to be a key level for the sterling versus US dollar. Let's take a look at the dollar versus Swiss. What is significant about this is it comes in around the 92.87-ish type area. You have to go to the daily chart to figure that out, and that comes against a 200-day moving average. If I zoom in here and take a look at that 200-day moving average, we really we tried to move above it here and here and here with no success. We weren't able to close above that 200-day moving average, and that's keeping a lid on the currency pair. So on Friday, we had the stronger U.S. employment report, although some of the other currency pairs like the euro and the sterling and the dollar versus yen saw strong moves. Not the dollar versus Swiss. We were pegged against that 200-day moving average, staying below that level. So that's going to be our key level in trading this week. As long as we stay below that 200-day moving average, the bias is a little bit more bearish for this pair. Now, on the downside, we have the 200-hour moving average. That's this green line right here because we're on the hourly chart here. And the 200-hour moving average is similar to the 200-day moving average in that we couldn't really close below that level as well. And so we need to get a close below 200-hour moving average to push this market to the downside. So 200-day up here, 200-hour right here. Either we're going to go there or we're going to go there for this currency pair. Watch those levels. The dollar versus Canada, we're trying to well, we tested the 200-hour moving average here on Friday's move to the upside. We had Canadian employment statistics come out a little bit better than expectations, but most of it was, or in fact, all of it was in part-time workers. So the mix of it wasn't all that bullish. So the dollar took strength against this currency, against the Canadian dollar, and we saw the dollar Canada move to the upside. We are above the 100-hour moving average, and we did hold against that level on the corrective move here, but we haven't had much success above the 200-hour moving average. So this is another one of those currency pairs. Either move above the 200-hour moving average and get above the 50% retracement here at the 112.2574 level. That would be more bullish. If we fail to do that, and we move below the 100-hour moving average, the bears from this area right here start to take control again. Note here how we held the 100-hour moving average here 1, 2, 3 different times. The break above it has turned what was resistance now into support. So that's going to be a key level on the downside for the dollar Canada and trading this week. The Aussie versus the US dollar, another one of these currency pairs that was stuck in between the 100 and 200-hour moving average. We are opening up lower below the 100-hour moving average and trading today. So if the market's able to keep that 200-hour moving average as a ceiling, that would be more bearish here for this pair, looking for our low levels here. First getting below the 77.20 to 32 level, and then we have the low price down to 76.25 on the downside for the pair to test the next level on the downside. Off the daily chart, just keep in mind of this. We have connecting these lows, a low to a low right here. In last week's trade, our low price tested that trend line and held. So put that trend line in and pay attention to it in trading this week. If the bears remain in control below the yellow area right here, we could head on down toward a test of that trend line at some point later on this week. Finally, I'll take a look at the New Zealand versus US dollar on an hourly chart, and this currency pair is also hanging around two converged moving averages, 100 and 200 hour moving average. They're only 13 or so pips away from each other, and we're trading right in between them right now at around the 47 level. We're going to be looking for either momentum to the downside or to the upside above the 100-hour moving average or below the 200-hour moving average to determine the early bias for this currency pair. Fundamentally, for that currency pair, we have some good economic data come out in employment situation, but the Governor Wheeler is still trying to talk the currency pair back to the downside. Doesn't look like they're going to tighten rates or ease rates anytime soon, so that's why we have a little bit more bullish bias here for the New Zealand versus US dollar. So there you have it, a look at some of the major currency pairs as we enter the new trading week. Good fortune with your trading this week. My name is Greg Michalowski for ForexLive.com. Bye-bye now.